Hey everyone. Last week, as expected, the Federal Reserve raised the overnight rate by 75 basis points, taking the federal funds rate to the 3.75% to 4% range. That's the highest it's been since the beginning of 2008. This rate increase, which was well telegraphed by the Federal Reserve, was pretty much already baked into the market. But the real information, as usual, came during the press conference. Three key points made during the press conference could have considerable bearing on commercial real estate. The first is the Fed's perspective on raising interest rates going forward. Basically, they suggested that they're done front-loading rates. The heavy lifting is over, and going forward, 75 basis point movements are less likely. A 50 basis point increase is still expected in December, but Chairman Powell did not take 75 basis points off the table completely. Powell said, at some point, it will become appropriate to slow the pace of increases. But he also said, incoming data suggests that the ultimate level of interest rates will be higher than previously expected. The Fed also acknowledged the time lag between their rate movements and the resulting effect on the economy. Together, these statements have been interpreted to mean that going forward, the rate increases will be smaller, but they will continue for longer and ultimately raise rates higher than the Fed originally thought. For commercial real estate investors, that's a mixed blessing. On one hand, it suggests that rates could increase substantively over the next year, meaning that debt capital will become increasingly expensive. On the other hand, if the Fed takes slower, smaller steps, some of the uncertainty and the disconnect between buyers and sellers could ease. In a lot of ways, the real estate market is dealing with whiplash. The rates have moved so quickly that the market is having a hard time keeping up. In the 90 days, give or take, from when a property goes under contract until it closes, the interest rate may move 100 or 150 basis points. That can radically affect the underwriting, and it's a driving force widening the buyer-seller expectation gap. So a slower pace of movement could help stabilize the commercial real estate transactional market. The second thing that caught my attention was commentary about the labor market. Powell said that reducing inflation will likely require a sustained period of below-trend growth and some softening of the labor market. He later said the labor market is very strong and households have strong balance sheets, so it may take time to get inflation down. I think this reiterates the statement Chairman Powell made on September 21 regarding the unemployment rate needing to rise. If that's the case, the Fed will allow or perhaps even encourage job losses in the effort to get inflation down. The Fed has signaled that its top priority is beating inflation into submission with rate increases, and they're willing to put the economy into a recession if needed. That couples with the third thing that caught my attention. When a reporter asked if the window for a soft landing has narrowed or if it's even possible, Powell said, "Has it narrowed? Yes. Is it possible? Yes." Powell then reiterated that a soft landing is always difficult. He also said that no one knows if there's going to be a recession or how bad the recession would be. But the Fed's job is to restore price stability so that the labor market benefits over time. Other comments made at the press conference suggest that the Fed won't let up until they see a clear downward movement in the inflation rate that indicates it will retreat to the 2% range. So, for commercial real estate investors, last week's Fed announcement suggests that interest rates will continue to rise, although the pace of increase could slow. The other takeaway is that the risk of a recession in 2023 is rising. The Fed won't blink if it comes. And remember, we may be facing a bumpy road in 2023, but if the Fed's plan works, inflation will come back down and the economy will enter a new growth cycle. And that's why your investment strategies need to look forward 3 years or longer, and why you need to keep your eyes on the horizon.